I'm delighted to be here with you. I'm going to be talking about two very important sources of income, two income streams, somewhat opposite to each other, and how the understanding of both could radically change not just your financial future and destiny, but if taught at the right time, can change a choice of career or profession. I believe that if this was taught to me at a very young age, there's a possibility that my career path would have been different. I strongly believe, and I know for a fact, that some of the decisions I made would have been slightly different. Now, the first of the two is what we call active. And here I'm dealing with income sources or types. The first is active and the second is what we call passive. Passive. Now, these are very important but different. There are two ways of really making money. There are two ways of becoming wealthy. One of them is simply by working for money. And in this option, we have money as the master and you as the servant or you as the slave. You see, you must serve or you must master. You can't do both at the same time. With option one, about 96% of the population subscribe to working for money. And this is what we're taught at a very young age. You go to school, you get a job, you go in every morning or every evening, you exchange your time, which is your most important asset. You exchange your time, and in exchange for that, you're given some money. That will come in the form of wages, salaries, bonuses, tips, but it comes in proportion to what you do. In other words, the value you create generates the income you have. Now, it's a very limited way of earning money because it really depends on your ability and availability. In other words, if you don't invest your time, you don't earn. It's a very limited way. And one of the reasons it's limited is because you will always have expenses to maintain a choice or a style, a standard of living. But if your income is based on the investment of your time, then it means, for example, if you lose a job, your income disappears, but your expenses remain. If, for example, the company goes under or sells or merges and there's a downsizing, it means that your income disappears, but your expenses remain. So the first way of earning money, which is the active way, is a very bad way of earning money. Sadly, this is what we're teaching every single, with the exception of perhaps less than 1% of the students at a young age. Now, the second way of earning money is simply by having money work for you. Here you are, the master, money serves you. This simply is what we call you exchanging a portion of your time temporarily to create a level of foundation upon which you can start building wealth. It's not something you just do for nothing. Now, with this option, we go into what we call the passive measure. Here people get very misled, and I'm going to deal with this very slightly. With the active measure, we've established you have to invest time in order to get money. With passive measures, it means money works for you, so money is creating more money for you. Now, passive income is something that is created as a result of you having money work for you. Unfortunately, many people think of this as being something for nothing. Passive income doesn't mean that you do nothing and money comes to you every single day. Passive income doesn't mean that you wake up in the morning, do nothing, and someone sends you checks. That's very misleading. Passive income is simply income created as a result of making a decision not to use active means, but making a decision to use leverage means. Now, this is the key. The word there is leverage. With passive income, the activity doesn't disappear, unlike what many people think. The activity doesn't disappear. The income is passive. The activity is leveraged. This is so good, so important, and I've got to say that again. With active means or active income, the income is active. The activity is active, and it requires, in many cases, physical labor. You have to invest your efforts, you have to invest your energy, you have to invest your wisdom, you have to invest your presence. And that is the reason why active income is not that great, because you see, you're like a walk-in warehouse of greatness. You have your senses: sight, sound, touch, taste, smell. In addition to that, you have your higher faculties: imagination, willpower, intuition, perception, and reason, memory. You have all of these, and every time you're working for money, if you're working in an activity that you're paid to do, you have to channel all of you to bring out the best in what you do, meaning that you can't have your imagination wandering off creating wealth and you're working for someone. So your presence is required, and that's the reason why we say the activity is active. With passive income instead, the activity is not active, it's leveraged, meaning other people do it for you. In other words, with passive income, you use what we call other people's money, other people's time, other people's knowledge, other people's experiences, and you use wisdom to create the passive income. That is how it's created. It's not that the activity disappears. No, the activity is leveraged, the income is passive. Now, how do you do this? You do this simply by having money work for you. But in many cases, like I started, many people would start in the same way. You begin with active income. You take a portion of what you earn. It could be 10%, it could be 15, it could be 20, it could be 30. You invest this in an investment. This investment or assets takes the capital you put in and it starts to create an interest. You take the original capital plus the interests, you reinvest it again, and over time you continue doing that, what we call compounding, and then it gets to a point where you have a solid base of a certain amount of money, and this amount of money is then invested in again in another investment vehicle, and that investment vehicle starts to pay you a passive level of income. But all these activities here are being done by other people on your behalf, and you only put what we call a level of management time to make sure that this income increases and that this investment appreciates in value. That is the difference. If you want to be wealthy, the key is this: minimize active investments or active income, maximize passive investment, passive income. And I simply use the word increase the level of income you're generating from assets and from investments, and decrease the amount you're earning from a job. Now, let me conclude by saying this. For some people, you have a level of passive income from opportunities you have, but those opportunities are not assets. Let me define what I mean by that. I'm not suggesting that they're not creating a cash flow, a positive cash flow to you, which is income. That's important. But by that, I'm saying that they don't meet the second criteria of what I consider every asset should be. A definition of an asset is something that, after the original investment of capital or resources, creates an income flow to you, a passive, positive rather, income flow. That's an asset. So an asset must, number one, create income, positive income flow. Number two, it must also appreciate in value. So there are some people who have income, passive income from a number of opportunities, but those opportunities are not tangible because they're not in the form of an asset, whether intangible or tangible, but they don't have any value. They're creating a level of cash, but unfortunately, they have a time limit. Therefore, the income they generate is not infinite. Always look for assets or investments whereby the income generated should be infinite and the original investment should appreciate in value. That is my recommendation if you want to be wealthy. Find investments, not just income sources. It's not about income sources alone. You want those income sources to be steady, reliable, continuous, and appreciate in value as well. God bless.